Well, Mike, I want to thank you for taking the time today to really just take us through a bit of an overview of what's been happening in the markets and the economy for the past little while. So much has changed. If we go from a quarter to quarter, there seems like there's just a whole new discussion every quarter of what the hot buttons are. But I think there's a general trend that we're starting to see. So I'm really anxious to go through the material with you today. So maybe what I'll do, I'll pass it over to you, and we'll just have a chat about the information you've got to present today.
That's great. Thanks so much, Scott, and thanks for having me on today. You're right. It's been a pretty crazy year so far in 2022. So we'll walk through some information here and maybe help provide a little bit of perspective about how we're thinking about things at the moment. And so if I jump straight in, we know that markets this year have been very challenging. So what we've got here across the top is what the broad markets have done so far to the end of September in 2022. And by the time this video goes up on the website, things will be significantly different because where we are in Q4 is a lot of these negative numbers are less negative today, with Q4 having been quite strong so far. But what you can see, broadly speaking, is all of the major indices, including bonds, are down in the double-digit territory this year, and it's been quite the storm for balanced portfolios that have exposure to these equity and fixed income asset classes. And we know why. We know it's the war in Ukraine, which has led to rising global inflation, rising interest rates in response. The higher likelihood of recession due to higher rates have really weighed on bond and equity markets this year. And we've seen quite a revision or a switch, a pivot, if you will, between what has been leading the market over the last few years to what's been leading the market this year. And clearly it's been a very strong year for energy and quite a weak year for technology, which is quite the reversal from where we were 2 years ago during the pandemic.
Well, I mean, I think, just that point that you've just made there, which is if you look at all the different asset classes, you've literally got a perfect storm, and there really has been no safe harbor to be hiding in. And I think that's what has caught a lot of people, or has caught a lot of do-it-yourselfers, so to speak, off guard, is that they say, okay, I'm in a balanced portfolio, I should be protected to some extent on the downside when things do go a little bit haywire, but there was no safe harbor, and they experienced significant negatives in an asset class that really historically shouldn't be giving that level of volatility. But the reality is, when the interest rates, and it's not like the writing wasn't on the wall, but when the interest rates were reduced artificially for so long, and then had to be brought back up so rapidly, it was just a huge negative that just really, I think, spooked a lot of people, and has really had people really question, the discipline that they're looking at or the approach that they're taking. So it's really been an interesting experience, at least the first half of the year, to see how everything went so negative so quickly.
It's true, actually, and if you even go up a level from that, it points to the importance of diversification, and it points to the importance of having the right asset mix, including cash, including exposure to less correlated asset classes such as alternatives, where it makes sense to try to dampen some of that downside, and try to get a sense of where our clients are in terms of the acceptability of downside risk. I mean, we have to be realistic about things, that markets do go down from time to time. We know the long-term trend is higher, but you have to be able to live through those inevitable downturns in a portfolio and persevere in order to benefit from those higher upsides. And just to show how unique a year it's been, we've got a slide here that shows about 46 years worth of data. This is a U.S. data. It's a little bit deeper than what we would have in Canada, but it shows the S&P 500 returns on this axis, and the Bloomberg U.S. aggregate, which is the U.S. bond market, the broad bond market, on the horizontal axis. And we read stock returns from bottom to top, and then we read bond returns from left to right. And so anything north of this horizontal line is positive stock markets, and anything to the right of the vertical line is positive bond markets. And this relationship between stocks and bonds, which we're so used to and so programmed in our brains, has held for almost 50 years, which is when stocks are negative, so south of the line here, bond markets have typically been positive to provide some moderation in balanced portfolios. Here's 2022, which is this massive outlier where we've had both stocks and bonds negative. Now, this is backwards looking, and these are details that have already happened this year. So when you think about what happens going forward, there may be some reason for optimism based on where we are for those who can persevere through this.
Yeah, and I think what happens is people tend to look at what's happening today, that it's going to continue forever. And when they see, the statement shock that happens when they open their statements, and they see, performance over the past, well, not only 6 months, because a lot of the last 6 months has pulled a lot of the performance they've had over the past 2 or 3 years. And when they see that, they think, "Oh my gosh, this is just going to continue. I need to make some massive decisions and massive changes," which, quite honestly, is probably one of the worst things they could. But it is, your word, the phrase you used as this year being such an outlier is kind of exactly that. It's one of those anomalies that takes place every so often, and you can't just sort of extrapolate it forward, saying it's just going to continue forever. So I think there is a high level of optimism that when you can, as you say, persevere through this, there's a lot of opportunities that are presenting themselves.
Exactly. And it's this concept of prepare and don't predict, right? And we don't know what the future will hold, but we need to prepare for what the inevitable could be, or those bumps along the road. So I wanted to jump in a little bit here on what drives markets, and it's largely behavior. It's largely investor behavior and what expectations are. So there's a great quote here from Howard Marks from one of his memos, and if you haven't read his memos, I highly recommend them. They're long. They're about 9 or 10 pages each generally, but they're a great Sunday morning read with your coffee. He's got really great perspective. So he says here, in the real world, things generally fluctuate between pretty good and not so hot. But in the world of investing, perception often swings from flawless to hopeless. So it's these extremes that get exacerbated, whether it be the extreme run up in 2020, or where we found ourselves in the first 8 to 10 months of this year. And there's lots of evidence that sort of points towards this. There's some anecdotal things on CNN. There's a business fear and greed index, which is a way to gauge stock market movements and whether stocks are fairly priced. So here you can see, in the span of just over 2 weeks, the sentiment of the markets has moved from extreme fear to greed, which doesn't make any sense, because if you think about what the underlying businesses are doing on their day-to-day running of their operations, the value of those underlying businesses do not change with this type of extreme that you start to see with their stock prices, which are supposed to reflect fair value. So if we think about how we've positioned client portfolios, we've got this, and this is our unrestricted diversified strategy, which is a balanced fund. It's a proxy for balanced clients. It's the stock and bond mix, does not include any alternatives, just a traditional 60-40 type portfolio. We've positioned our client portfolios to be slightly overweight stocks and slightly underweight fixed income. So we're keeping our eye on the longer run here, and we'll get into some of the details in a couple of minutes. But the overall perspective, if you think about how I've positioned it with this fear and greed index and this hopeless to flawless type scenario, we tend to think of things as glass could be half empty, but it's also half full. So we spoke a little bit about the start to the year. We spoke a little bit about the facts of what's driving this glass half empty perspective. But we do think that some of the right questions really to be asking as we look forward and what our expectations are in the future is, what is the impact of the current environment on a business's cash flow and earnings? How strong is that business's balance sheet? I mean, we're not going to dump our equity holdings out of fear. We want to understand, how are these businesses going to behave? Do they have the ability to perhaps acquire some of their weaker competitors? Do they have the balance sheet strength? And what do we think the market is currently pricing in to those businesses? So as we look forward, and our style really reflects this, we think there's reason for some optimism. Bond yields are a lot higher than they've been in well over a decade. Stock valuations have compressed. They're much more attractive. Our style, which is a value style, is back in favor, and we really do think that stock picking, or paying attention to the business fundamentals, is really going to matter as we go forward. And we're starting to see some cracks and some early signs of inflation perhaps starting to retreat. And what that's resulted in is a lot of our portfolios have been quite resilient so far.
Well, I mean, what you just said there, I think, is a really important point. That investing is not, I would argue that the majority of people who make investment decisions on their own have done so without even looking at a financial statement for a company that they're buying. It's based purely on a short-term emotional feeling as to whether or not it's a good investment. And the deep dive, I think, that needs to take place. That's where what's the word I'm looking for? It's sort of the not so glamorous part of the business, right? It's
Right.
hard. It's tough. And when you can, marry the work you do from using a calculator and deep dive into the boring financial statements, and it's not even the financial statements, it's the footnotes of the financial statements that I think is where the value comes from. And when you do that deep dive and then have the ability to actually extrapolate that into forming an opinion as to, what is this company actually worth? What's the right price to be paying? Is the current price reflective of the value, or is it over, whatever it happens to be? That work is so difficult, but it's necessary. And it just shows that, just watch the flow of capital that's moving in and out of the markets. It generally flows at the exact opposite way it should be flowing. And
Exactly.
And it's so frustrating, because people then have these bad experiences with investing, but it's not because of it's because their discipline that they're following, or the lack of discipline, I should say, is probably just making it seem like it's a hope and faith kind of experience. But when you know your numbers, that's where I'm trying to get with this conversation, is when you know the numbers, you actually start to recognize all the opportunities that are presenting themselves right now. And that's where I think that's what investing is all about. It's not about, buy high hoping it's going to go higher. It's about buying at the right time and buying the companies that are the right companies to acquire for the long term. I mean, hoping to never have to sell, because the company's just going to keep on growing and growing and growing. But it's that work that goes into that is so difficult. And I bring that up because I feel that there's so much, emotional responses to what's happening when the logic is just being forgotten.
Right. And I agree with everything you've said, but let's not underestimate or understate the importance of management teams. So when we look at businesses, yes, we look at everything that's publicly available, financial statements and so on, and try to understand the business and the competitive landscape as best we can. But it's management's decisions who are influencing what those balance sheets looks like. They're allocating capital, they're allocating profits and cash flows from that business every single day, and making decisions about the future of growing the business, whether to take on debt or not, whether to fund projects internally or not. So we spend a lot of time trying to understand management's decisions in the past, how they've behaved during past recessions, during past crises, what their philosophy is really regarding levering the balance sheet or not levering the balance sheet. So it's really, they're making decisions with our capital and our clients' capital, with us being investors every single day. So we want to make sure that that's a very, very disciplined approach. And that's something, to your point, Scott, that's something that do-it-yourself investors have no access to, and no ability to make those types of decisions. And really, I guess another way of saying what I'm saying is, rarely are you going to see us initiating a position or even getting out of a position if it's on page 1 of the newspaper. Right. We're much more involved in businesses that are on page 9, page 10, that are not in the limelight, good, bad, or indifferent, but are just solid cash flowing businesses that aren't maybe the flavor of the day, but they're those types of businesses that you can sleep well at night in your portfolio and own them. For some of the businesses we've owned on behalf of our clients, we've owned for decades or more.
Yeah, such a good point. Such a good point.
So these are, we understand, like I said, the hopeless, and this really drives the narrative. So here you are on the left-hand side. These are all page 1 stories. Couple of covers from The Economist, house price horror show, how high will rates go, are we in a recession, are we not in a recession, so on and so on. And on the right-hand side of this slide is a consumer sentiment index. So this is done by University of Michigan on a regular basis. And without getting too deep into the weeds, what you can see here is that at the end of June, we were a very pessimistic bunch as a whole, as a collective. And I don't say we in terms of the money management industry, I say we in terms of consumers. It's the most pessimistic we've been going back to, well, beyond, but this goes back to 1971. So in a very, very long time, even more pessimistic than during the Great Financial Crisis. So this is what's baked into the markets today. So where do we start to think about, okay, that's definitely that glass half empty scenario, but we look forward and we see that, okay, well, fixed income today has moved from very, very low yields a year ago. So this is a yield curve, and it shows very short-term rates. You'll remember it was close to 0 interest rates for a long time in the short run, and then all the way up to 30-year interest rates on bonds is the black line. Again, September of 2021. To shifting upwards to where this blue line is today, showing how far rates have come. And that's what's really impacted the negative results in bonds this year. The interesting things with bonds, though, is that they pay regular coupons. So those interest payments are reliable. So we know as we go forward, we'll continue to collect those interest payments, which are significantly higher today than they were a year ago. So we look at this and we say, well, now there's some options in the bond market of actually you could own everything from high quality bonds that are earning between 4 and 5%, all the way up the yield spectrum to high yield and secured loans that are paying 9, 10, 11% in bond portfolios. So we have some opportunities. And as we've structured our bond portfolios, we're running a yield at about 5.6% in those bond portfolios that for clients that have bonds.
Just from a curiosity standpoint, what would that yield have been if this portfolio was as it is today? What would that yield have been, say, a year or two ago?
Well, it would have started with a 2.
Yeah.
So 2.3, 2.5, 2.6, depending on the allocation between government, corporate, and those high yield bonds. Yeah, it's quite a significant difference. And incidentally, by the way, just I'll add this in because our high yield team thinks about this all the time, and we think about it from a allocation perspective. Even though high yield and loans today are yielding, like I said, between 9 and 12%, which is a huge number, because of where the government bond yield curve is, or what government bonds pay, it's still our view that even though that 9 to 11% is very attractive from a headline number, we don't feel that it's enough of a premium over government bonds to be going into these asset classes in a big way. We think they're not even pricing in the risk of any kind of a significant recession. So we're sort of moderate in our view on high yield and loans at the moment. So if we switch over to the stock side of the portfolio, this is sort of a busy slide. So I'll try to be high level, and maybe what I'll focus on is our is on the US index. What you see here is we've gone back over the last 10 years and calculated the forward price earnings ratios for US stocks in the S&P 500. And what that is it's just a measure of how cheap or how expensive a stock market or a stock might be. It's really shorthand. It's a bit lazy, but it's what a lot of people do to try to figure out, how hot is the market or how expensive is the market. And we call this a whisker graph. So what it shows is the very, very highest PE ratio. So the most expensive the markets have been in the last 10 years had a ratio of about 24 times earnings, which is this far right side. The far left side is the cheapest it's been in the last decade or so, which is at about 12 times earnings. And most of the observations, or I'll say 50% of the observations, fall within this gray box. So these are the outliers. This is where the market tends to be most of the time. So we would say fair value. So what we're seeing today is the US equity market is a little bit cheaper than it's been historically, not a ton. So it's probably fairly valued here. And when we look through to the individual holdings that we own, because we don't own the whole market, we just own a subset of companies that we think are really high quality. Our portfolio is exceptionally cheap compared to the market. And we see that across in the international portfolio. Canadian market and the Canadian portfolio are pretty close to being at their cheaper levels over the last 10 years. Now, we know we're going into a recession most likely. We know the earnings number is going to come down, and these numbers are going to change, but it does give you a sense of perspective of, we don't think we're putting money to work, or we don't think we're sitting out there on a limb from a valuation perspective. So, and just to tie it, go ahead.
No, I was just going to say that's very interesting, because what you indicated there was the blue triangle or the blue diamond on the S&P 500 shows the market. Mm-hmm. And what I extracted from your comments was that you're cherry picking of the companies that you would prefer to own, irrespective of what the market includes in their calculation. Your cherry picked portfolio actually shows how inexpensive, or what's the right word for it? You said cheap. How cheap I don't like to use the word cheap, but how inexpensive your portfolio is relative to the market, which means, I'm sort of jumping ahead, but if you look over on the right-hand side, when you've got a portfolio that's been consistent, that's now showing, the lowest levels it's ever been at, and then the forward-looking numbers of what's happened, over the next 10 years, that's a significant return that's sort of, on the horizon, so to speak.
Right. So we certainly feel like we haven't overpaid for anything in the portfolio at all. It's all really it's business first for us, right? We want to make sure we're invested in really great businesses that are really, really well run. Back to my earlier point, it's awesome the fact that they're so potentially unloved by the market, and that's why their prices are so cheap relative to their earnings. And we're not talking about companies that people don't know about. These are just companies that are not on page one, as I mentioned. And your point's well made, that, and it stands to reason, anytime you can buy things for a bigger discount, then its future growth will be higher. If you fully pay up and you pay huge prices, your expected return going forward is quite low. Just think about it in the context of anything. If you were in the market for a new car, that there's no discounts to be had these days, and you're going to pay full price. So when it comes time to turn it over or sell it at some point in a market that potentially 4 or 5 years might be flooded with inventory, you're not going to get as much out of it as you might have otherwise. So you could use the same expression for houses or whatnot. It's just the more you can buy something on sale, the better the value you're going to get.
Yeah, everybody loves a good sale.
Absolutely. And then when we look at style-wise, there's a lot of different ways to slice and dice this, but what we see is there's been very, very long periods of growth outperforming. And when we think about growth, we think about companies that promise really high profits in the future. They tend to have a lot of hype involved with them. And you can see some clear trends on this chart. If we look, this is back through the 90s into the tech bubble, we get a sense of what those growthy names were: technology, media, telecom stocks, and they just kept getting more and more and more expensive relative to their less exotic counterparts that might have been, drug companies and banks and so on. And then eventually that when those valuations get to extremes, you start to see that reverse. So it's lucky, I suppose, or it just so happens that these seem to be 10-year cycles, but you've got a 10-year cycle of growth outperforming, and then a 10-year reversion where you had value type stocks. And when I say value, these are just businesses like I was describing before that, again, not page one, but companies that have much more reasonable prices relative to the profits that they produce. And then we had a big long run of growth outperforming, and we think perhaps we're here in the early days of perhaps a bit of a value shift. And there's lots of reasons for us to believe that there's tailwinds, interest rates normalizing. We say, a lot of people are saying, and yes, we agree, interest rates are high and likely to stay high for a while. But if you really think about it in the context of the history of the market over the last 50 to 100 years, it's really just interest rates normalizing here from some extremes.
Interest rates relative to what? Relative to where they were, a few years ago when they were artificially brought down, or relative to where the norm is. Yeah, I think your point is valid that, we're not moving to a high rate of interest. We're moving to a normal rate.
Exactly. I'm not going to spend much time on this slide, but this just shows some of these high quality names that I was speaking about earlier. And again, these are names that we've owned for quite some time. And then when we talk about the resilience, just from a performance perspective, this is our balanced strategy. I won't dwell on the numbers for too long, but you can see on a year-to-date basis, of course, we're down, everybody's down, but our portfolios to the end of October are down about 6%. Those underlying markets that we're selecting our securities from, in those weighted amounts are down closer to 10. So this is what I mean by resilient and hanging in there. And if you think about that value growth slide that I showed you that had those 10-year, seemingly 10-year trends, this 2-year number corresponds pretty closely with where that inflection happened. And you can actually tie that 2-year number in almost to the point where the first COVID vaccine was announced in late 2020. So you can see over the last couple of years, there's been some significant value add in our portfolios relative to their markets, and it's been pretty much across the board, whether it's Canadian, US, and international stocks. And it's, yes, of course, there's what we did own and what we didn't own. There's certain names that we haven't owned over the last number of years because they've been too expensive. But I would say really it's this focus on quality, good balance sheets, really, really well managed businesses where in an economy that's starting to normalize, as I said, we do really think that fundamentals are going to matter, and paying attention to the details are going to matter much, much more than just jumping on the momentum train. And in the industry, we call it the greater fool theory, which is, what you alluded to earlier, buy something at a high price and don't even worry about it because you'll sell it somewhere down the road to somebody else at a much, much higher price than what you bought it for.
Yeah, that greater fool, yeah.
Yeah, we think that's unwinding. And then just quickly, obviously inflation is the talk of the day or the talk of the year. And we're certainly seeing higher inflation. We all see it. We've all experienced it. Credit to the Bank of Canada. I think they started raising rates aggressively early compared to what's happened in the Fed and in the US. So we've started to see some of our inflation data start to weaken over the last month or so. But this chart shows you on the US side that inflation is starting to moderate as well. So there's a few interesting things on this slide. One is these gray bars show what the market is pricing as the probability of a recession. I would say, these are interesting. But central banks have told us, they've said they're going to squash demand. They have to in order to get inflation down. And you can only do that by causing a recession. So forget about what the odds makers are saying or what the market odds are. We're going to have a recession. And, there's all kinds of technical definitions and lots of, economists will argue whether we are, whether we aren't. And maybe 4 years from now, there will be agreement that, oh yeah, that actually was a recession. But it's happening. We're going to have it. But the light at the end of the tunnel here is that these lines are important. So the light blue line, it shows us what the expected overnight rate, or the Fed funds rate as they call it, what the expectations are a year from now. So you can see that the expectation for interest rates in the US, and the same would be true for Canada, are coming down 1 year out. And what you can see from the dark blue line, this is actually inflation expectations, but it's 2 years out. So you can see that inflation expectations are coming down fairly rapidly. And you can see inflation expectations were quite high going back into March. And we were only just starting to talk about inflation back then. And here we are 9 months or 6 months, 7 months later, showing lower inflation rates expected. And then as we start to think even longer term out, and it's not on this slide, but when we get out to 5 years, those longer term inflation expectations are now back to that mid 2% range, which is the area we've long expected them to return to. So when you think about what people were talking about earlier in the year about transitory inflation or non-transitory inflation, I think it's just a matter of time. So transitory is going to take longer than expected, but that's the way time is. Time takes time. And then that's sort of the demand side of the equation. And on the supply side of the equation, we're starting to see some of those supply chain disruptions starting to improve. Among other items, you've seen used car prices come down quite significantly from where they were. There's a lot of commodity price inflation earlier in the year. You remember seeing truckloads full of lumber going down the highway, and you'd think, oh, that's the equivalent of gold bars going down the highway because lumber was so expensive. Well, that's, lumber's back to pre-pandemic pricing levels. So we're starting to see some anecdotal evidence on the supply side that things are starting to ease. The yellow line is interesting. This is the ships in queue at LA and Long Beach. So we've started to see a rollover in how many ships are waiting to unload. So if we think about those key takeaways, we do think that inflation is going to come back to the target range, 2 to 3%, probably sometime in 2024. Higher rates are here for a while. We will likely be having a recession, but there's tons of opportunities for us to invest client portfolios, with now bonds starting to pay us something, which is the highest yield we've seen in a long time. We talked about equity valuations being very, very attractive, where you've got longer time horizon assets. So those make sense. I think our style certainly has some tailwinds with higher rates, higher inflation, tends to favor the types of businesses that we own with solid moats and really, really well managed. And we do think there's some opportunities for active stock pickers. Now, one last thing, because we do hear this from time to time, and we touched on it a little bit earlier, has to do with market timing. And is there a time to be all out? So there's a few fun slides that we added here at the end. And I think most investors intuitively know this, but when you're in the heat of it and they're very emotional about short-term results, you do tend to have these thoughts go through your brain every once in a while about maybe I should get out. Maybe it's different this time. This is what we hear all the time. It's different this time. You don't understand. Like things are different. So what we've shown here is a chart of the S&P 500 and what the narratives were at that time that were driving some of the fear. And there's always fear. There's always something to worry about, which is why we say you should prepare and not predict. But you can see all kinds of different headlines at the time. However, you do see that over time and over the medium to longer term, the stock market continues to rise through those setbacks along the way. And what is not so obvious on this chart is that if you're so inclined to exit and to get out, what you can't see is that the very best days in the market typically are right on the heels of the very worst days. So a lot of advisors have seen a slide like this, or a version of this slide. So here's our version of the slide. If you look at the S&P 500 over the last 25 years to the end of September, which is about 6,000, over 6,000 trading days. And if you had just been invested that entire time, you would have had a return of just over 7%, almost 7.5% by investing that entire time. If you missed the best 5 days of those over 6,000 days, your return is 2% less on a compounded basis. That's significant. So that's a quarter. You lose a quarter of it. And I can tell you those top 5 days probably were right on. One of them would have been the day after March of 2009 when the market bottomed. That was an awful, awful day. And similarly, if you missed the 10 best days and the 15 best days, you simply missed the 20 best days and you're not doing much better than T-bill returns over the last 25 years. So it's really important to stay the course.
I mean, you're saying, just to reiterate what you're just saying, like you're talking 20 days out of 6,000.
Correct.
Yeah, it's amazing to me the power of those days. And you're right, those days come on the heels of really, really uncomfortable days.
Absolutely. And if you think about how the brain works, and I spend a lot of time reading behavioral investing books, and I think that's what we all are. We're just a bucket full of behaviors.
Right.
If you give into your need to sell, and it's normal. I mean, if you keep getting punched in the mouth, then you're going to eventually back away from that. And it takes everything in your being to go against the way you're hardwired to continue to sit there and to take it. But if you think about it, if you get out on or around an awful, awful day, markets are down 20%, and you think, I just can't deal with this anymore, I'm out. And the rationale goes something like this: I'll get back in. I know I'm a long-term investor, so I know I'll get back in. And I'll get back in when things have settled down. And what that means to me is, what you're actually saying is, I'll probably get back in when things have settled up, which is, the market bottoms, it does a recovery. We're programmed to think it's fake. I don't believe it. It's probably going to stay down for a long time, because we have this bias that you talked about earlier on, which is to think, well, whatever's just happened recently is going to continue to happen forever into the future. And you typically would not be comfortable getting back in until an amount of time has passed. 3, 6, 12 months have passed, and you see that there have been very few down days, and you think that the coast is clear again. Well, guess what? You've probably missed 75% of the recovery, maybe more, and you're starting to give into your coast is clear, all the headlines are positive. And that's actually the time when you should be most worried, when the coast seems like it's clear and that nothing can go wrong.
Such great advice. I mean, it's just such great advice. That's all I can say. If you let emotions dictate your investment decision process, you're going to be wrong pretty much all.
Right. So you have to get your mind around, how much can I lose in a portfolio and still sleep at night and persevere? That's the key fundamental question. Because at some point, the market will hand you something awful. Because the market breaks every 7 to 10 years or somewhere in that neighborhood. We've seen it time and time and time again. It's the people with the most success, the investors with the most success, are the ones who just sort of, look at what they own, understand the quality. Yes, it's like gardening. You have to pull out some weeds from time to time, but understand that it takes time and persevere through.
Yeah, and I think that question is better asked at the point of a market setback, because people when the markets are roaring forward and you say, well, how much are you willing to see on the downside? They're like, oh yeah, I'm good with volatility. I'm fine with that, because that short-term bias is they're seeing volatility on the upside. oh, this is great, high risk, high return. I'm good with high risk. I think we need to be asking those questions more so today to protect them against themselves in the future.
Exactly. What else have I got in here? Just a diversification slide. This is a quilt slide, and it just shows you how each colored box represents different asset classes, and you can see there's no predictive power in this other than oftentimes you see that the low asset class in one year ends up being the high asset class in terms of returns in another year. We sort of plotted these blue boxes, which just show a balanced fund that mixes and matches all of these boxes into a balanced type portfolio. And while it's never at the top of the heap, it's also never at the bottom of the heap. And one of the secrets to growing wealth, and it's not that complicated, is if you can have above average returns, doesn't have to be top of the tables, but if you can have above average returns for a very long period of time, in the fullness of time, you will be somewhere near the top of the heap. And many studies have pointed to that, and it's just sticking to that discipline. That's all I got.
Well, that's great. Well, listen, awesome. That was just fantastic. I love going through that information because of the logic that it brings to the surface. And everything that I've heard from our discussion really wraps around, getting rid of the emotional side of things, looking at the logic, doing the deep dive, and understanding your numbers. And if people are unable to do that for themselves, then we need to hire somebody to do it for us, because it's not something that's easy to do. It is a discipline. And the thing that I really admire about what you've done is that you stick to your discipline. The discipline is what you're being hired for. There's nothing worse than saying we're going to hire somebody and they're going to do this, and then all of a sudden they say, you know what? Now we're going to change things. We're going to do it differently now. Well, that's not discipline. Right. That's just throwing darts at a dartboard and shooting from the hip, and that's not investing. So the discipline is really what's great. So, anyways, I really appreciate you taking the time and going through all that. Great information, and look forward to chatting again further, and I always look forward to our chats.
That's great. Likewise, Scott. Thank you so much, and all the best for the holidays.
All right. Thanks, Mike.